During December 7th to the 16th, 2022, the Chinese Communist Party, or CCP, made two main policy changes that are like 180 degrees different. First, starting on December 7th, full-scale epidemic prevention and control was lifted suddenly and completely. Second, between December 15th and 16th, the CCP held the Central Economic Work Conference in Beijing, where it started to promote openness and stimulate the economy. According to an analysis on December 15th by the Wall Street Journal, China's leader is planning to redirect the country's focus to boosting the economy, with senior government officials now setting a strong GDP growth target of more than 5% for 2023. At the same time, they are de-emphasizing ideology. That is to say, Xi's government is now going all out for economic development. But the problem is, will this adjustment bring China's economy back on track of high growth? We find it highly improbable. Over the past 3 to 4 years, strengthening and expanding state-owned enterprises, pushing forward public-private partnerships, cracking down on internet-based companies in the education and training industry, and touting common prosperity are the main strategic directions for economic development under Xi Jinping's new era, including preventing many Chinese companies from listing in the US in the name of data security, etc. But at the Economic Work Conference on December 15th to the 16th, the CCP surprised outsiders by releasing signals of a major reversal when deploying economic work for 2023. The Economic Work Conference was held against the chaotic backdrop of the first wave of outbreak, peaking after lifting the national control and a surge in the number of deaths in Beijing as a result. The conference was attended by a host of senior Communist Party officials in office and those who rose from the 20th National Congress in October 2022. The annual economic conference repeated the idea of deepening reform and opening up comprehensively, emphasized vigorously boosting market confidence, and suddenly loosened restrictions on real estate, internet-based platform industries, and the private economy. Sharply changing its policies, the CCP hasn't reviewed its fault in the dynamic zero-COVID policy, explained or apologized for the massive positive cases, deaths, and medical crushes caused by the sudden lift of the lockdown. At the conference, it first boasted about itself, saying it coordinated epidemic prevention and control and economic and social development in 2022, an achievement that was not easy and should be cherished. After bragging about the achievements, the conversation turned quickly, admitting that the foundation of economic recovery is not yet solid. The triple pressure of contracted demand, supply chain impact, and weakened expectations is still high, and the external environment is turbulent and unstable. Regarding the sectors of the capital market, private enterprises, and platform economy, the CCP has made a complete turn. In the previous 2 years, it was said to prevent the wild growth of capital, set the red and green lights for capital, and improve the security review mechanism. Now, like a flash, it has changed its remarks to respect the laws of the market, encourage and support the private economy, platform enterprises, protect the rights and interests of entrepreneurs, etc. Admittedly, before the conference, there was a sign that the CCP might make such an adjustment. On December 15, 2022, at a press conference, the PCAOB, the U.S. Public Company Accounting Oversight Board, confirmed that it is now able to fully inspect and investigate Chinese companies for the first time in its history. After the exposure of the fraudulent trading volume of China's Ruixing coffee in 2020, the U.S. Congress passed the Holding Foreign Companies Accountable Act, HFCAA, in the same year, requiring all companies listed in the U.S. to disclose their audit records. If they refuse to disclose their audit records for 3 consecutive years, they will be ordered to delist from Wall Street. With more than 200 Chinese companies listed in the U.S., delisting them would have caused market turmoil. At the time, the U.S. gave the CCP a 3-year grace period, while the Chinese government has been refusing to provide truthful audit data. On August 26, 2022, a change took place when the China Securities Regulatory Commission announced an agreement with the PCAOB to provide a 7-week window for audits of U.S.-listed Chinese stocks to be inspected in Hong Kong. This is, in actuality, China catering to the regulatory requirements of the U.S. capital markets. The Chinese government's 3 red lines regulatory requirement in 2020 for debt risk of real estate companies has led to the collapse of China's Ponzi-like real estate bubble. At this conference, the CCP urgently delivered emergency support, stating that it would ensure the stable development of the real estate market and meet the reasonable financing needs of the industry. Moreover, the conference proposed a number of stimulus measures for expanding consumption as well. These adjustments were completely unimaginable even 2 months ago. In October 2022, before the 20th CCP conference, the main term promoted by the CCP media was people's economy. The much-anticipated report of the 20th Congress barely mentioned opening up. It was consistent with the previous signal that the party should control the economy and return to a planned economy with limited seclusion. After the 20th Congress, party leader Xi, who was re-elected for a 3rd term, led the most powerful members of the CCP's top tier, the 7 new standing committee members, to pay a visit to Yan'an, the birthplace of the CCP, claiming that the party should vigorously carry forward the spirit of self-reliance and hard work, and get ample food and clothing by working with our hands. At the same time, signs such as the resurgence of public-private partnerships and the return of supply and distribution coups were observed to have come to the forefront of public attention. They served as evidence that the opening of the economy to the outside world was a thing of the past. These contradictory policies seem to indicate that the CCP's regime is in imminent crisis and major economic concessions have to be made. Domestically, it was the CCP's adoption of 3 years of extreme epidemic prevention and control measures that accelerated the departure of foreign investment and the closure of numerous small and medium-sized private enterprises, shifting the industrial chain, which in turn led to more unemployment and sluggish consumption. Internationally, the US and Europe have sped up their economic and technological decoupling from the CCP. The overlapping pressures at home and abroad have brought the CCP's economy at the brink of collapse, as evidenced by the negative fiscal revenue growth in all Chinese provinces in the first half of the year 2022 and the skyrocketing unemployment rate. So how do the Chinese people feel about these changes? Have they found something to look forward to? Many Chinese netizens don't buy it. Some remarked, "You've been deprived of oxygen for 3 years, you're half dead," and then suddenly it hits home that no one is working for him to make money, and immediately it wants you to put on a ventilator. From our observation, Xi Jinping's government has a big challenge on hand to revitalize the economy. Why? Let's start by taking a look at China's real estate. As reported in previous episodes, China's cities are so indebted that many are already bankrupt. In a recent meeting of China's largest city, Tianjin, its party secretary pointed out that Tianjin's debt ratio had reached 500% and the city was bankrupt. According to public information, Tianjin is estimated to have a combined financial strength of 250 to 300 billion renminbi in 2022, while the city's interest-bearing urban investment debt was 14 trillion renminbi, 5 to 6 times the combined financial strength. Urban investment debt is generally invisible government debt, mainly used for the real estate industry. How can the huge government debt and the equally large liabilities of the real estate giants be repaid? China's real estate economy is a Ponzi-like monstrosity that can be considered the #1 industry in the universe. The entire upstream and downstream of real estate accounts for about 30% of China's GDP. Cracking down on real estate is likely to destroy the overall economy. Real estate deregulation can only lead to increase the bubble and debt. It's fair to say the real estate industry has kidnapped the Chinese economy in a deadly fashion. Second, let's have a look at consumer spending in China. In the absence of job opportunities, there is little room for the general public to increase their ability to spend. Currently, infections are spreading at an alarming rate throughout China, but people can only depend on themselves for protection. The CCP's early relaxation of outbreak controls is intended to stimulate consumer spending and economic growth. Still, China must survive the expected wave of infections and the resulting economic losses because consumers are unwilling to risk entering public places or workplaces. The newly released 2023 McKinsey China Consumer Report shows that 58% of urban households surveyed want to save for a rainy day, the highest level since 2014. At the economic conference, after confirming the continued opening to the outside world in 2023, the CCP has drawn up a new pie for private and foreign enterprises. For private enterprises, the conference expressed that the requirement of equal treatment for state-owned and private enterprises should be put in place institutionally and legally, and the development and growth of the private economy and private enterprises should be encouraged and supported in terms of policy and public opinion. Protect the property rights of private enterprises and the rights and interests of entrepreneurs in accordance with the law. Leading cadres at all levels should solve problems and do practical things for private enterprises to build a pro-clear government-business relationship. Chinese media reported on December 18th that after the conclusion of the Central Economic Work Conference, more than a dozen CCP provincial party secretaries returned to their provinces and held meetings to propose three key phrases: openness, confidence, and expanding investment. The new provincial party secretary of Zhejiang province went to Alibaba to express his support and to highlight Xi Jinping's talk on promoting the platform economy. Zhejiang province is China's private economic powerhouse and a major e-commerce platform base. Hangzhou City is where many online companies such as Alibaba are registered. Over the past 2 years, the CCP has intensified its anti-monopoly efforts, launching an investigation into Alibaba and finding it a heavy 18.228 billion renminbi, or about $2.6 billion in April 2021. In October 2020, Alibaba founder Jack Ma publicly criticized the CCP's financial and regulatory system for stifling innovation. Authorities have since launched a series of purges against Ma's business empire, with Ant Group's IPO called off and Ma disappearing from the public eye for a time. The British Financial Times on November 29, 2022, cited sources as saying that Ma and his family had been living in Tokyo for nearly 6 months. The provincial party secretary extended an olive branch to Alibaba, a key private enterprise, on behalf of the CCP central government. Still, entrepreneurs like Jack Ma, likely to have ceased partaking in this, should have been frightened by the CCP's policies by now. Because entrepreneurs and capital for profit are based on contracts, trust is its core element. The government, under the leadership of the CCP, competes with the people for profits, does whatever it can, and goes back on its word. So what can it do to make private entrepreneurs trust and feel at ease? On the other hand, we can also see that Chinese entrepreneurs and wealthy people have no confidence that the CCP can revitalize the economy. Reuters reports that Chinese tycoons, whose earnings have been hit hard in the year 2022, are looking for overseas private equity and real estate investment opportunities in countries like the US and Japan. While Chinese tycoons are not new to investing outside the mainland, a large portion of their past investments have been in Chinese assets, such as shares of Chinese companies listed in the US. But now they are increasingly worried about the poor economic outlook due to the outbreak surge as a result of the sudden lifting of epidemic control and the unknown nature of the war in Russia and Ukraine. According to Eureka Hedge, during the year ending in November 2022, Greater China-focused hedge funds have lost 12.9%. Possibly the worst year since 2011, highlighting the bleak outlook for returns in China. Founder and Chief Investment Officer of RGA said they have received many inquiries from clients in its Greater China Family Office, that is, the family office dedicated to full-service wealth management for super-rich families who want to understand U.S. economic policies and investment rules. Previously, sources of wealth for these people weren't from buying U.S. stocks or investing in U.S. real estate, but that's starting to change. Li Eva, head of Greater China Equities in UBS Global Wealth Management's Chief Investment Office, also said wealthy Chinese may have made a lot of money from the domestic market over the past few years. Still, now they're finding that that won't work anymore. She added, Chinese investors have learned their lesson this year, and they realize that diversification is so important. A portfolio manager of a Hong Kong-based family office with more than $1 billion in assets told Reuters that he had slashed the proportion of Chinese assets in his portfolio to 1/3, from 80% at the end of 2021, and would cut further. The portfolio manager, who asked to remain anonymous because of the sensitivity of the issue, said he had increased his investments in the energy and real estate sectors overseas, particularly in Japan and the US, as well as in risky investments after trimming his China assets. A partner in another Chinese family office with more than $1 billion in assets under management said his firm is spending a lot of time researching fund managers and investment opportunities in Japan and the US, and is also closely monitoring the reopening of China. Reuters, citing two sources, said the U.S. consulate in Hong Kong held two networking meetings in October and November to help connect family offices in Greater China with U.S. fund managers, underscoring the interest of wealthy Chinese families in investing in the U.S. We firmly believe that open cooperation is the general trend of history, and mutual benefit and win-win cooperation are desired by people around the world. China adheres to the basic national policy of opening up and firmly pursues a mutually beneficial and win-win opening strategy, promotes the construction of an open world economy, and continues to provide foreign businesses with a more market-oriented, legalized, and internationalized business environment. China will continue to be a hot destination for global enterprises, including those from Germany and Australia, to invest. The CCP hopes to attract foreign investment, but the global economy continues to slow down and the outbreak is surging in China. The Federal Reserve has raised interest rates, and there is an inverse interest rate gap between the US and China. If international capital doesn't hurry to leave China now, it is feared that there will be great trouble ahead. China is still the world's factory, the world's largest exporter, and the second largest importer. The Chinese customs reported on December 7th that China's imports and exports both fell sharply in November 2022, falling more than experts had previously predicted. Exports fell by nearly 9%, imports fell by more than 10%. Such a large drop is rarely seen in the past few decades. The current trend is that the U.S. economy, including the European Union and the United Kingdom, will be in a mild recession in 2023. Their markets will be shrinking, so no large market is open to China, thus providing no way for the CCP to boost economic growth through foreign exports. In terms of the international environment, the toughest test for the Xi Jinping government will be the U.S. In 2022, the U.S. has been imposing a succession of high-tech sanctions on China. It has also reached out to and convinced allies such as the Netherlands, Japan, and South Korea to go along with its sanctions policy. According to a December 13th Bloomberg report, the Biden administration plans to blacklist Chinese chipmaker Yangtze Memory and 35 other Chinese companies to prevent them from buying certain American components. Now that Japan and the Netherlands have agreed in principle to join the U.S. in adopting export controls on China, it would be nearly impossible for China to produce advanced chips below 14 nanometers in the future. In terms of high-end chips, it can be said that China is 5 generations behind the US. In the production of chips, with each generation of technology, its integration will roughly double, its power consumption reduced, and speed accelerated. So on the basis of the 5 generations differences, the gap will gradually increase in the future. That is to say, China is not at all on the same level as the US in the field of high technology or data. This trade embargo hurts China's economy greatly. The future economic development of any major power depends on data. If a country's computing power is no good and neither is its memory, its economic growth will be held hostage by other countries. To sum up, the white paper movement, economic stagnation, and the crisis of party demise have prompted the CCP to turn the ship around to make a temporary gesture to cater to public opinion. The CCP doesn't really respect economic laws because its structural contradictions haven't changed, and its methods of rule of man haven't disappeared. After more than 70 years of the CCP regime, these characteristics have become increasingly clear to today's Chinese and the world. Perhaps these are the essence or root problems why the CCP's dream of a prosperous economy is difficult to realize.